Welcome to the ZionsBank Economic Update. My name is Joseph Mayans, and joining me is senior economist Robert Spendlove to discuss the current economic conditions. Robert, over the past couple months, we've really been talking about how we've been seeing some weakness in the U.S. economy. And over the past couple weeks, that weakness has really begun to materialize in some of the new surveys and data points that have come out. We saw a little bit of that in the recent employment report, continued slowdown in job creation, but we also saw a few bright points in there. Why don't you walk us through what we've seen there a little bit?
Yeah, and it's really important that there's a big distinction, and we'll talk about this a little bit in some of the data that we've been looking at between our hard economic data and our soft data. And there's starting to be a bigger divergence between those two. So if we look at probably one of the most important pieces of economic data we get on a monthly basis is the monthly jobs report. And it came in at 136,000, which is below the estimate that we thought was going to come in, and it's also below the previous month. Now, 136 is kind of an interesting number. So it takes about 100,000 jobs per month just to keep up with population growth. So we're really looking, the floor is right around 100,000. But then when you kind of put it in context of what we've seen recently, in 2017, we had 180,000 jobs per month created. 2018, it actually accelerated to 223, but now we're down to an average of 161. So we're below that average, so we can see the slowing of the economy, slowing of job growth, but we're still above that critical level of 100,000. So it's kind of that sweet spot where we're seeing slowing, but we're not seeing growth really low yet, but we're starting to see that trend. On the other hand, when we look at the unemployment rate, and this was a real surprise, unemployment rate dropped from 3.7% down to 3.5%. Again, the lowest since December of 1969, so the lowest in 50 years. And doesn't make a lot of sense that you would see such a big drop and such a low unemployment rate with kind of the overall labor force slowing down. But they actually come from two different surveys. So it's one report, but two different surveys. One is a survey of employers, the other one is a survey of households. The first chart we looked at was the employer survey. This is the household survey, so there's a little bit of a disconnect going on. However, when you look at, so the blue line is unemployment, the green line is what we call underemployment, which is discouraged workers or people working part-time for economic reasons. Again, dropped down to a 19-year low. We haven't seen that since around 2000. So really low numbers in our employment and unemployment. And also, we see that the labor market is doing a lot better job of connecting people to the resources in the economy.
Right. So I know when the employment report came out, talked about wage growth. Along with all of the good unemployment, typically when you think about unemployment coming down, you think about wage growth going up, but we didn't see that. And we also seen, like to your point on the unemployment rate, it's reaching a much wider portion of the economy. African American unemployment all-time lows, Hispanic unemployment all-time lows, and also some within the different demographics of education levels. Why don't you talk about what we saw with wages and why that was surprising to us?
Yeah, and this is another one of those, so there's data going on right now that kind of has economists scratching their heads. We don't have good explanations of why it's happening. We know what is happening, but we're not exactly sure why it's happening. So again, if you've got a really tight labor market, which we have, if you've got very low unemployment, which we have, you would expect to see, think of your Econ 101. When you've got high demand and low supply, prices should go up. And in this case, those prices are wages. So you should see a big escalation in wage growth. Now, if you look back before the recession, we were seeing wage growth above 3.5%. And we started to see this, and this is why the Fed was so aggressive in raising rates a year ago and before, because they saw this going on. They saw this big escalation in wage growth going on. And then right here, right around January of 2019, it stalled out, right around 3.4%. And ever since then, it's been dropping. And then we saw a big drop this month, down to 2.9%. No one was expecting that. And it just doesn't make a lot of sense. When you look at that trend, as the labor market continues to tighten, we see wage growth dropping. Now, there's a few theories about what might be happening. It might be increased globalization. So we're able to move jobs around and move production around more easily. But then another one, if you look at, we call it labor productivity, has been going up just in the last few years. So if you think about mechanization, automation, the kind of the gig economy and artificial intelligence, where it used to be very difficult for firms to replace their workers, now it's become much easier. So think about going to McDonald's, where now they've replaced some of their workers with kiosks. Or think about going to the grocery store, where instead of having a checker, you go do self-check. And so those are examples of firms finding ways to get around or deal with the very low unemployment rate.
Right. And so building off some of these trends, we're seeing the slowdown in job creation, we're seeing slowdown in wage growth, but we also had some new surveys come out over the past couple of weeks talking about more worry in the manufacturing sector, and maybe that's even spreading to other areas of the economy, kind of surrounded in the environment of the trade war and slowing global growth. What do we see? Yeah,
so what we've talked about so far has been our hard data. But then when you look at our soft data, and so hard data is usually backward-looking. Soft data is kind of forward-looking. And soft data is surveys of expectations or surveys of how different groups feel about how things are going. So this is one called the Institute of Supply Management Manufacturing Purchasing Managers Index, the PMI. And what we see is in the latest data shows a contraction. Now, it's the second month of contraction, but what was significant was now we're at the lowest point since the last recession. So people working in the manufacturing industry are feeling more nervous. They're feeling like the times are getting tougher. We're seeing a big drop in demand. In fact, specifically what really impacted this was exports. Demand for exports is way down, and again, it's down back to levels going into the last recession. So, and why does manufacturing matter? Manufacturing is what we call basic employment. It's what really funds the rest of the economy. It's the clusters that really feed the rest of the economy, and manufacturing is critical. But then when we look at the other sector of the economy, so there's both a manufacturing and a non-manufacturing part of the survey. Now, the non-manufacturing level is down, but it's still above that level that would indicate a contraction. So this actually is looking okay to me, and this is critical, because even if the manufacturing sector is struggling, the critical part is that service sector, and the critical part of the entire economy really is the consumer. And how does the consumer look? Once again, consumer confidence is down in September, down about 125, but this green line is critical. Over 110 indicates that people feel like the economy is prosperous. And you can see that for a long time. For many years after the recession, it was not above 110. And then it jumped up in 2016 and 2017 and has remained within a pretty tight range. And so this is looking good. Now, this is critical. The consumer is 2/3 to 3/4 of the economy. So if consumers continue to feel good, the economy will be okay, but this is a critical component.
So when you tie all this together, the Fed is going to be meeting at the end of the month here to make a decision on interest rates. Looking at some of the downward trends, looking at some of the bright spots like unemployment, what do you see the Fed's next move being?
Yeah, the Fed has already cut rates 2 times this year. They'll be meeting 2 more times. I really think that the Fed, it really depends on what happens over the next few weeks, but I think the Fed will cut again this year. The big debate is whether they cut in October or whether they wait till December.
Right, very well. Well, thank you, Robert. Thank you for joining us for this economic update. For more information and analysis, please visit ZionsBank.com/economy.